Welcome to M&A Talk, the #1 podcast on all things related to mergers and acquisitions. Brought to you by Morgan and Westfield.
Why would a VC keep a company private? Is that just because the IPO market wasn't hot and it just wasn't attractive for them to take a company public, or why would they choose to do that?
Just to go back a little bit, I mean, the way it works is they have to continue to grow the company to make it worthwhile to continue investment in the company, right? And so valuation is, as you know, Jacob, it's more of an art, right, than a hard science, right? So, the traditional ways of valuing companies using discounted cash flows, using market comparables, maybe building out a DCF valuation and then building back within the sector and relating that, other transactional, comparable transactions. Those are all ways to do it. But the VCs have addressed even more sort of growthy model, and they usually look at addressable markets, right? And not necessarily what cash has come in, but they look at what can be, right? So they've looked at, okay, I can take over this market with this technology, and this is the size of what can be accomplished. And so a lot of VCs, and I'm not saying everyone, but a lot of VCs kind of view it as a land grab, right? So I'm going to spend as much money as possible to gain as much market share in these certain sectors in order to gain control of, whether it be eyeballs, whether it be traffic, whether it be, market share in that particular segment. And then they're able to dictate terms and payments and flow of commerce in the end. And because of that, it takes a different type of perspective, right? It's a long-term investing perspective where you're not necessarily making profit for a long period of time. You're just growing out the base and attracting customers. And it takes that kind of long-term discipline in order to do that, in order to grow, right, into some of the larger segments that they're attacking. So we're talking about social media, you're talking about advertising models, you're talking about other sorts of technology adoptions. And so that's kind of very much long-term perspective. And in a private setting where you're not answering to the quarter by quarter, okay, how much are you spending here? How much are you spending here? Then it's an easier management process if you're private, because you can continue growing, continue spending money into that sector as long as you have the right metrics, and continue growing through that. So it's proven to be successful. But inherent in that is they have to keep driving the equity value up. So like if you're investing in seed round, the A round must be higher, and then the B round must be higher than that. And so they're continually investing at a higher valuation determined by themselves. And then when you get to the public markets, sometimes what happens is the valuation is too high. And then they realize that the public market investors won't swallow it at that price. So if you're looking at, let's say, you invested at a $20 billion market cap for a giant unicorn, like WeWork happened, and you wanted to take it public at 80 billion, and the public banks are saying there's no way that anyone's going to take it at 80 billion. And then WeWork kind of implodes upon itself because there's so many contingencies and covenants that get tripped, right, as a result.
So who is using public equity to make acquisitions? I know the show here is about public equity, using public equity to make an acquisition. Is it mainly venture capitalists doing that, or who exactly is doing that?
I think private equity firms will use it. I think the VCs have started to get more keen on the public equity use because they're using SPACs, just to take their companies public. So they've been started to get a little more inclined to that because they can control the process themselves. The private equity firms have always used it, especially those that are more savvy in the public markets. And companies, right? Corporates, especially the corporate companies, have always used public equity to do M&A. And it's always helped, right? Because let's say this, Jacob, like let's say you're a public company and you trade at, I'm just going to say arbitrary, like 100x forward multiple because you're a technology company with great technology and the market has awarded you that multiple.
Got some great capital for making acquisitions there.
Right. Absolutely. And any acquisition you purchase is going to be at a lower multiple than you are trading at, right? So it becomes easy to do an accretive acquisition. And then as a result, it becomes easier to grow your technology company off that base, right? I mean, as we've seen with Tesla and some of these other behemoths of technology companies, they've got this game plan down to a science, right? Like they've just mastered it as far as using their stock price to the ultimate, right? And catering to the public investors, whether it be retail or institutional, and being able to use that for whatever they want. I mean, a little while ago, Tesla, had what's called a shelf offering using the ATM facility. And within a few days, they were able to raise $5 billion. They were able to build out every facility that they needed for infrastructure just by doing that. If they had to go through any other way, let's say those facilities were in the form of a company and M&A that they want to take over, if they didn't have the public markets, it would be an arduous process to do it. But, as far as a matter of a few days, they could get that done. If they had another acquisition that they wanted to acquire, they could do it very easily because of the value of their equity.
Now, are we talking about any company making an acquisition here with their equity, with their shares, or are we also talking about somebody forming an entity, a public entity, just to go out and acquire companies?
Both are possible, right? But then, if you're to be listed on the NASDAQ, I think you would need at least some source of technology or basis for a listing, right? Like you would have to have some sort of ongoing operations and some basis for which you have operations.
And so is the shell company a myth?
There's much less of them these days now. It's been cleaned up quite a bit. A lot of the shell companies are listed on the OTC. And then what's possible, is to list into an OTC and then reverse in a operations of some sort for a company and then uplist onto NASDAQ. And so that's a very possible avenue.
M&A Talk is brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. If you've enjoyed this show, don't forget to subscribe and leave a review. Learn more at morganandwestfield.com. While we take reasonable care to select recognized experts for our podcast, please note that each podcast presents the independent opinions of such experts only and not of Morgan & Westfield. We make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. Any reliance on the podcast information is at your own risk. The podcast is for general information only and cannot be considered legal or professional advice.